Hi traders, welcome to Shift FX Academy YouTube channel. Okay, in Shift FX, we've been able to simplify the complexity of trading the market, whether Forex, crypto, or indices. Okay, but in this video today, we'll be introducing you to Forex trading, foreign exchange trading. So before you continue watching, please don't forget to subscribe and like this video, as that will enable us to create more video like this. And as well, you can leave in the comment section the next topic you would like to see. Okay, and your request will be granted within the shortest period of time. Okay, so let's go straight to today's course. I will be introducing you to Forex trading. Okay, I'll be introducing you to Forex and what is Forex trading all about. What are the things you need to know about trading the financial market in regard to currency? Okay, those are the things I'll be teaching you today. So the first thing we'll be doing today is we will start by looking at what is Forex. What is Forex? Okay, Forex is a short term for foreign exchange, sometimes abbreviated to FX. And this is the global decentralized trading market of the world's currency. Okay, so Forex trading is, I know you must have come across the word Forex, is actually an abbreviation for foreign exchange. Okay, and I'm sure this word is not new to you, because if you've ever been to the bank before, if you've ever tried to change the dollar to the naira or any currency of your choice, you have gotten involved in the foreign exchange market manually, I mean physically, not digitally. But right now, what I'll be showing you is how to trade the market digitally. So at this point, I've been able to establish that Forex is actually an abbreviation for foreign exchange. Okay, if Forex is an abbreviation for foreign exchange, what then is Forex trading? Okay, we now know that Forex is foreign exchange. So, which means foreign exchange can be traded digitally. Okay, so Forex trading is a short form for foreign exchange. It refers to the buying and selling of a nation's currency. That's what foreign exchange is all about. Foreign exchange is you using your country's currency to buy another country's currency. And in doing this, you would notice that the value of your country's currency differs from the currency of another country. Okay, you might need $2 to buy £1, for example. In order for you to buy £1, you might need $2. So what foreign exchange or what forex trading is all about is you use your currency, the money you have at hand, you use it to purchase another currency. Why would you want to do that? You're doing that because you're projecting that, or there is a news or there's an event that has made you realize that that currency you're wanting to buy is going to appreciate in value. What I mean is it's going to go up in value. So you take your own currency, which is likely to depreciate in value, you sell it before the other currency begin to appreciate in value. That's what forex trading is. Okay, so you use your country's currency, or you use the currency of one country to buy the currency of another country. Okay, this might sound a little bit strange, since most of the times we normally exchange money for stuffs that we use. For example, we normally exchange money for a new t-shirt, or maybe a warm meal at a local restaurant. We can wear the t-shirt or we eat the meal that we have bought with our money. However, in forex trading, we are exchanging money for money instead. Isn't that amazing? You take your money, you use it to buy another money. All right. Um, but why would anyone want to exchange money for money? It doesn't seem to make sense. I understand, but it's a very powerful business you can get yourself involved in if you can learn the rules that guides it. So I use the money I have to buy another country's money. The reason why I would want to do that is because the currency I have at hand is likely to fall in value, and I don't want to hold it and it falls in value. I want to use it to buy another currency before it starts falling, because if it's falling, it's a sign that another currency is likely appreciating in value. Okay, you would get to understand more of that as we go in deep into the course. Let's look at the basic terminologies used in forex. One of the terminologies that is very common in forex trading is as much as every other market. you usually have these two sets of guys, even in our local market. You can't just go to the market and find sellers. If you find sellers only, there is no way the sellers are going to make money. And if you find buyers only, there's no way the buyers are going to make money. So in the Forex market, we have the buyers and the sellers. So the terms that are used for these two sets of guys in the market is we refer to the buyers as, we refer to them as the bulls, and we refer to the sellers as the bears. Okay, this is one of the basic terminology used in Forex. Okay, we refer to these guys as the buyers, which is the bulls. It's just a terminology and you need to familiarize yourself with it. So when you hear the word, when someone said the market is bullish, what we are trying to say is there are more buyers in the market than sellers, which means that currency pair is going to appreciate in value. When you hear the word bear, it's a sign that the sellers are more in the market, which means price is likely to fall in value. Because in the Forex market, when we buy a currency, what happens is it appreciates in value in any market at all, just like in the crypto market. When more people are buying a particular coin, a particular cryptocurrency, what will happen is it will keep appreciating in value. The cost of it begins to go up and it begins to increase in value. If more people are selling it, in that case, we would say the market is bearish. That's because we have more people letting go of that coin, as a result of which it will begin to fall in value. So the strategy behind trading is you want to do what other people are doing. When a lot of people are buying, you want to go into the market and buy as well, because more people are buying, there's every tendency that the market, the price of the particular instrument that is being bought will appreciate in value. And when more people are selling, there is every tendency as well that the price will fall in value. So these two sets of guys, you always find them in the market. They are called the bulls and the bears, which is the buyers and the sellers. A trader is both of them. You are not just a buyer, you're not just a seller. At one time or the other, you are buying a currency pair. At another time, the currency pair you bought initially, you can end up selling it again. The reason is because the market is not static. It keeps going up and coming down. Price keep appreciating and depreciating. So you want to buy it when it's going to appreciate, and you want to sell it when it's going to depreciate. The question is, how do you know when it's going to appreciate and when it's going to depreciate? That is what this course is all about. Okay, so when you subscribe to this channel, you'll be getting more of our courses like this that would explain to you how the market actually works. Okay, another terminology we'll be looking at that is very important is going long. This is an action you perform as a result of noticing that there are more buyers in the market than sellers. So when the market is bullish, I will advise my students, I would say it's time to go long. Let's go long on Euro USD. Let's go long on GBP USD. Let's go long on GBP JPY. We can choose any pair at all to go long on it. As a result, as a matter of fact, if there are more buyers in the market. So going long is actually buying an instrument. Then going short is actually selling an instrument. Okay, these are the two terminologies I've just discussed on this slide. The Forex market is characterized by buyers, which are the bulls, and sellers, which are the bears. Both wants to be in charge. When the price or value of a currency rises, the buyers, which are the bulls, take over the market. I said that before. When the price or value of a currency falls, the sellers, which are the bears, take over the market. So at that point, you want to sell. When the buyers are more in the market, you want to buy. When the sellers are more in the market, you want to sell. How do you know? You would get to know as you follow this course, as we drop the videos on this channel. Okay. All right. Another terminologies we'll be looking at base currency, quote currency, spread, exchange rate, going long and going short. I just discussed these two, so they're out of it. Let's talk about base currency. What is base currency? Base currency, these two go hand in hand. I'm going to explain base currency and quote currency together. Okay, I'll be discussing the both of them together. So I'm talking about base currency and quote currency together. What is base currency? Base currency is actually the currency you are buying, okay? The currency that appears first when you look at the pair. I think before I would mention that, I would like to say currencies are in pairs. Let me go a little bit further. I might come back to this. Currencies are in pairs. What I mean is you can't just trade the euro alone, okay? You can't just trade only the euro, but rather you trade the euro against another pair. That's the rule of the game. You can't just decide that, okay, as it stands now, I just want to trade only the euro. No, you have to trade the euro against maybe the US dollar, maybe the Japanese yen, maybe the pounds. So you can't just, you can see in this case, what we have is euro USD. Now, I'll be using this to explain the base currency and the quote currency. In this case, the euro is the base currency, as you can see, and the US dollar is the quote currency. Why is that? The euro is the base currency because it's the first currency that is listed in this pair. It's not just the base currency because it's the first currency that is listed in this pair, but it's also the base currency because it tends to have more value than the US dollars. Yes, what I mean is it will take you will need more of the US dollar to buy the euro, which means the euro has more exchange rate value than the US dollars. Okay, so the base currency is the currency with the most value, like it's more valuable. I mean, it has a strong exchange rate. You will need more of the quote currency to buy it. Okay, so this is not static. You might check another currency pair, and what you would find is you would notice the US dollar can be a base currency to another currency. I think I have a perfect example of that right here. Like what you can see here, you can see in this case, the US dollar is the quote currency, but in this case, you can see it's the base currency. Why have I just said this? Because the reason why the currency is regarded as a base currency is because of the value it has against its counterpart, the counter currency, which is the quote, okay, the quote currency. So base currency is the currency with more of that has more value than the quote currency. So the base currency is usually the first currency that is listed in a pair, while the quote or counter currency is the currency that follows the base currency. Okay. Another thing I would like to show you is the spread. Now, what is this spread? If you go to the bank, if you go to your bank and you go to I think the Western Union area, if you go to the Western Union area of your bank, you would notice a board where different currencies are listed. You would see stuff like we buy US dollar at the price of the listed, we sell at the price of the listed. The difference between the buying price and the selling price of a currency is regarded to as a spread. What do I mean by that? Look at this perfect example. We have the GBP euro in this case. This is a pair, okay? The pounds against the euro. And I told you before, in this case, the pounds is the base currency because it has more exchange rate value than the euro, which means you will need more of the euro to buy just the pound, and you will need less of the pound to buy the euro. Now, you would notice the price are listed here. Look at the base currency right here. Notice the price of the base currency, 1.1575. That's the price of the base currency, which means what this is telling you is this is the buying price of the base currency, and this is the buying price of the quote currency. The difference between these prices is what is regarded to as a spread. You might not understand this very much now, but as you proceed in learning about Forex trading, you would remember most of the things I've said about the spread. Why is the spread important to a trader? The spread is important because you will be trading, you don't have access to the Forex market without the help of a broker. The broker is the middleman between the trader and the market. So different brokers have different spread. Okay. Some brokers spread are wider, some brokers spread are tight. Well, how to know the best spread is the spread that is tight. A spread has to be tight because the tighter the spread, the easier it is for you to make profit. Okay, the wider the spread, the harder it is for you to make profit. Anyway, as we proceed, we will get to that point. So the spread is actually the difference between the buying price and the selling price. Okay, that's what we have here, bid price and ask price. Okay, one is the buying price, the other is the selling price. Okay, so the difference between these two prices is regarded to as the spread. All right, so the difference in the buying price and the selling price is what is known as the spread. Okay, so I think I've been able to help you get understanding of that. All right, what do we trade in Forex? What we trade in Forex is value. Yes, what we trade in Forex is value. Okay, the value of currencies, which is expressed in price. Okay, is expressed in price of a currency against the other. What that means is, if I'm going to use the pounds that I have to buy a euro, why will I use the pounds I have to buy a euro? There could be only one reason. The reason why I'm going to be selling my pounds to buy the euro is because the pounds is likely to fall in value. So if I have 100 pounds, if I have 100 pounds and the pounds is going to fall in value, there's every tendency to fall in value to up to 70 pounds. And I'll be in loss of 30 pounds. So instead of me keeping that money in my account, instead of me keeping it in the bank account, I can place a withdrawal of it and use it to buy the euro in advance, because there's a projection that the euro is likely to appreciate in value. So when I sell my pounds to buy the euro, automatically I have traded the market. I have sold, I have bought as a result of value. I sold because what I have might fall in value, and I bought what will appreciate in value. Okay, that's the wisdom behind Forex trading. In fact, that's the wisdom behind trading generally. So we buy or sell a currency based on its value. We don't just decide to buy or sell. I'll be showing you the trading platform as we go on, and you're going to see how we do this digitally, because I'm not talking about you going to the bank and buying the US dollar or whatever. Okay. So one question we always ask ourselves is the currency falling in value or is it rising in value? Okay. If the currency is going to be falling in value on the long run, we would go into the Forex market and sell it against the currency that is rising in value. As you know, in trading, you can't just trade a currency. You trade a currency against the other. All right. So when a particular instrument is going to appreciate in value, what happens is we go into the Forex market and we buy it before the appreciation starts or before the appreciation begins. If it's going to fall in value, we go into the market and sell that instrument before the depreciation begins. All right. So, okay, that takes us to the next slide. Currencies are in pairs. Currencies are in pairs. Like I said before, you can't just trade one currency. Okay. What we do in the Forex market is, remember, Forex is foreign exchange. Okay. And these two currencies are foreign currencies. Even if you're using the euro, that's your country's currency. The US dollar is not your country currency. So it's still foreign exchange. So we have currency paired like this. This is one pair, just like your shoe, your right leg and your left leg. That's what we have here. So what we do in the Forex market is we trade these currencies against each other. Let me say this quickly. When I'll be talking about analysis, how to analyze the market to know when the market is going to be appreciating or depreciating, I'm going to be teaching you something known as fundamental analysis. It's one of the things I'll be explaining in our courses. I want you to take note of this now. I know this might be the first time you'll be hearing this, but take note of it now, because when we get to that point, you might need this. Okay. When the euro is going to appreciate in value, when there's a projection that the euro is going to appreciate in value, what we do is we buy more euro. We sell the US dollar. On this pair, because the euro is going to rise in value, the US dollar is going to fall in value. What am I trying to say? When the base currency is appreciating in value, it will result to the falling of the quote currency. And reverse can be the case. When the quote currency is going to appreciate in value, it can result to the fall of the base currency. So the both of them can rise at the same time. It takes the rising of one will bring about the fall of another. The fall of one will bring about the rising of the other. Now, what is the determinant of this? This is not synthetic. It's not being controlled by anything anywhere. What determines this is the state of this country's currency. If it is, the state of this country's economy. If the European economy is booming, things are moving smoothly, production, they have good GDP, that's gross domestic product. Their central bank is making good decision in regard to their currency. It will make the euro appreciate against the US dollar. If the US dollar is doing poorly in these areas I've mentioned, of course, the euro will keep appreciating and just keep appreciating and keep appreciating against the US dollar. If reverse is the case, the US dollar would be rising consistently against the euro. Okay, so take note of this simple stuff I wrote down here. I said any position, whether buying or selling in the Forex market, should be taken on the base currency. What do I mean? The base currency, when you look at the chart, I'm going to open a chart for Euro USD quickly. This is the trading platform. When you look at this, this is Euro USD right here, as you can see. Euro is the base currency, US dollar is the quote currency. And I said any buying or selling you're making in the Forex market should be done on the base currency, because everything you're looking at on this chart is telling you about the base currency. Look at this. You have two colored candles right here. I'm explaining this for those who are very new to Forex trading. You have two colored candles. These are called candlesticks, okay? Price, this is what is representing price. And what you see at this corner, all the one point you're seeing at this corner is showing you the price of the euro, the price of this currency pair, okay? Now you observe something. When the market was going up, it was showing more of the green candle. When it was coming down, it was showing more of the red candle. All this demonstration, everything you're seeing here graphically is representing the base currency. Okay. So when you notice that the euro is going to appreciate in value, let's say from this point, the euro is going to go up in value from this point. Can I replay this? Let's see. Let's assume this was the state of the market at the point, and you heard that the euro is going to appreciate in value, which means from this point you heard the euro, this is at the price level for this is 1.1750. Then you heard that the euro is likely to go up all the way to 1.22000. That's another price level. The euro is appreciating in this case. If this is the case in the market, the euro is appreciating. All you need to do is to buy the euro, go into the market and take a buying position, and you watch what the market will be doing on the long run. So when the appreciation starts, like what we have right now, when the appreciation of the market starts, you are automatically in profit because you bought at a lower price and now the euro has appreciated in value. How about if there is a projection that the euro is going to fall in value? Okay, there is a projection by, of course, analysts and other set of people we have in the market. If there's a projection that the euro is actually going to fall in value, all you need to do is sell the euro. Remember, if the euro is going to fall in value, it's a sign that the US dollar will appreciate in value. In this graphical representation, you are not going to be taking a buying position. Rather, you're going to be taking a selling position. You're taking a selling position. You're taking a selling position because the euro is falling in value. what I'm trying to say is digitally, when you are buying or selling in the market, your buying or your selling is centered on the base currency. If you are buying because the base currency is appreciating, you are buying, you are taking a buying position in the market digitally. If you are selling because the base currency is depreciating, you are taking a selling position. You are not coming to buy because the US dollar is appreciating in value. Because when the euro falls, I hope you're able to comprehend what I'm saying. Because when the euro is rising, the US dollar is falling. So in the graphical representation I just showed you, you'll be buying the market. I hope you get that. If reverse is the case, if the US dollar is going to appreciate in value, it means the euro is going to fall. In the graphical representation I just showed you, you will be selling the euro. You'll be taking a selling position on that graphical representation. That's what I'm trying to get to you now. Okay. So if there's a projection that the euro is going to fall, I'm not going to be buying, even for the fact that the US dollar is going to be rising. I'm going to be selling because this graphical representation is representing the euro. Okay, so see, it starts falling. At this point, I'm selling the euro. Automatically, I'm buying the US dollars. Automatically. Because this, but what I'm doing here is because the base currency is the euro. So I'm selling it. When it's appreciating, I'm buying it. When I'm buying it, it's a sign that I'm selling the US dollar automatically. All right. You are free to drop a question on the comment section of this video. I will address it because this is where a lot of traders, because I'm going to teach you fundamental analysis, you will have to have understanding of this basic knowledge. It's very important. You can't duck from it. So any position, whether buying or selling, taken in the market should be taken on the base currency, not on the quote currency, as the quote currency does the unseen reverse of any position taken on the base currency. Okay, so let's go on. So the base currency, or the currency you are buying when you trade the forex market, the quote currency or the currency you are selling when you trade the forex market, reverse can be the case. I just explained this. I'm using the euro USD, for example, because it's one of the most traded currency pair in the forex market. Okay, if you are trading this pair, euro USD, okay, when you're buying the euro, automatically you are selling the US dollars. When you are selling the euro, automatically you are buying the US dollars. That's what this is aimed to passing across to us. Okay, now let's look at types of currency pairs and their classification. Type of currency pairs and their classification. There are actually three types of currency pairs. They're actually classified into three. We have the major currency, we have the minor currency, and we have the exotic currency. These are the three types of currency pairs we have in the market. Let's take an example of them. What are the major currencies? Okay, the major currencies are Euro USD, GBP USD. Of course, you can see their full name. The Euro, which is the Euro and the United States dollars, the Great Britain pound and the United States dollars, the US dollar, the Japanese yen, the US dollar, the Swiss franc, the US dollar, the Canadian dollar, the Australian dollar, the US dollar, the New Zealand dollar, the United States dollar. These are the major currency pairs. Why are they called the major currency pairs? One, you observe that they have the US dollar attached to them all. Each and every one of them has the US dollar as their pair. Secondly, they are called the major currency pairs because they are the most traded currency pair. Another question is, why am I showing you this? Why am I showing you different currency pairs? The reason why I'm showing you different currency pairs is because the major currency pair has a tighter spread. Remember when I was talking about spread? I said spread is the difference between the buying currency, the buying price and the selling price. Because these currencies belongs to countries that have a developed economy, as a result of which a lot of people are involved in trading them digitally. As a result of that, the spread of these currencies tend to be the tightest, like they can be very small compared to other currency pairs. All right. Let's look at the minor currencies. The minor currencies are actually, there are a lot of them. I didn't list every one of them here. The minor currencies are GBP, JPY, Euro, GBP, GBP, JPY. They have their nicknames as well. Okay, you can make more research on that. The essence of the nickname is when you're reading the news about them, most times they don't call them by their, they don't call them by all these names. Sometimes you would hear in the news, they talking the newscaster, whoever, or market analyst might not say Euro USD. You might find him, he might say fiber, he's referring to Euro USD. You might find him say the cable, he's talking about GBP USD. You might find him say the Kiwi, he's talking about the New Zealand dollar, United States dollar. So you just want to familiarize yourself with all that and all that. Okay, so this is the first part of the video, and I'm going to be ending the video now. Please do well to subscribe to this channel, as that will enable us create more videos like this. And please leave a comment in the comment section, letting us know the next video you would like to see. Okay, so I'm not done with the introductory class to forex trading. You can watch the next video that continue the introduction to forex trading. All right, see you in the part 2 of this video.